Yo, what's up, family? OG Larry, your favorite OG, tapping in to give you some information that might help you change your financial situation. If it doesn't help you change your life, don't take this as financial advice, because nothing I say is financial advice. I can't tell you what to buy, wholesale, anything like that, but I can tell you what to look at before you invest in a company. Use 3 numbers that you want to know before investing into any company far as long-term investing. So this ain't for no quick traders, no day traders, anything like that. I will have a video out probably tomorrow for how I'm gonna make more money for short term, in the short term, but this is for my long-term investors, people who are or beginning investors, people who want to know what to look at before investing in a company. So the 3 numbers that you're gonna want to look at is price to equity ratio, price on return on equity ratio, ROE, and PE ratio, price to earnings ratio. Return on equity ratio is what a business is doing, how good a business is doing at making money with the money that you've already put into it, or what shareholders have already put into it. So say, for instance, I'm gonna give you an example. Say, for instance, me and my sister, we go in business together. We buy a hot dog stand. We both have 10 grand, so we put 10 grand a piece into this hot dog stand. And at the end of the year, this hot dog stand has made 20% profits. So we have 20% return on our equity. So we've made $4,000 in profit off at 10K a piece, so which is $2,000 for her, $2,000 me. We made 20% return on our equity. So if we can make 20% return on equity, maybe 25 sometimes, maybe 20, but keep it at a steady 15, 20, 30% on return on equity year over year for 5, 10, 15 years, then that's a company that you want to look at putting your money in, because they're taking your money and they're making money with it. So with that in mind, and not to drag this out, return on equity is when the shareholders' money is being parlayed by what the company is doing with it. So take that and put that in your clip, because it's one of the numbers that you're gonna want to know before investing in any company. So then next, we're gonna have debt to equity, which is the number 2 thing you want to know. Debt to equity ratio is going to tell you how safe it is to invest in this company. So the number 1 rule per Warren Buffett is never lose money in the stock market. And rule number 2 is don't forget rule number 1. So you want to invest in safe companies. You want to put your money to where the company is not in a lot of debt. So if the company was to have a downturn, can it still pay its bills, or is it going to go bankrupt? You don't want a company that's teetering on bankruptcy anytime they might have a lack of sales or whatever the business might be. So you want to know how much the company is carrying relative to the equity. So if you have actual ownership and the value of this company is a lot more than the debt that's involved, then you can take that company, you could take that number and put it in your clip. So we have return on equity and debt to equity. That's 2 things right there. So if you want a company that with low debt and that can manage whatever debt they have, and as long as it's not high. You don't want a company that has a 100% debt to equity ratio, because debt can kill a company. So you want a company with a low debt. If you go back in the day when Apple was first starting, they were a cash cow. They didn't have a lot of debt, but if you didn't know couldn't foresee what they were going to do in the future, you would have passed on that company, because you didn't know anything about it. But they had this big cash cow and this big cash reserve, and they were making moves to and preparing for what we now know is Apple today. iPhones sales going crazy, killing profits, a cash reserve that's comparable to almost any. So that's another thing that you want to look at, is a company in a lot of debt, or is a company managing its debt. And the last thing, the number 3 thing you want to look at, is because in no particular order, but these 3 things you want to put together before buying into a company, and that's the PE ratio. That's price to earnings. Let me get my notes on PE ratio so I can make sure that I got this right for you. Is the PE ratio means what you pay versus what you get. Now understand, what you pay ain't always what you get. Sometimes you can pay for too much money for a stock that's overvalued, and sometimes you can get a fair deal, and sometimes you can get a stock that's undervalued. I'd rather get a stock that's undervalued and put my money in to where I'm gonna see my money grow, than rather a stock that's overvalued, or because I would take a stock that's fair valued also. But the price matters, because numbers tell you if a stock is cheap or not, but expensive, or whether it's fairly priced. But price matters, because if you don't know how great a business is, you could overpay for that company, because the company could have a heck of a name, could stand for this, that, or the other, but if they're not making money, then it might not be that great of a company to invest your money in. If you get poor returns, price is what you pay, value is what you get. So you want a company that is valuable, underpriced, so that you can have value when you buy into the company, and that's going to take you a long way as far as putting together your investment portfolio. So if a company earns $5 a share and the stock is trading at $100, then that's a PE ratio of 20. And you want to keep your PE ratio in the sweet spot, is what they call a sweet spot of 15 to 20%. Because if you get up to the 50, 60, 70% PE ratios when a company is that expensive, that means that company is dependent on growth, and that company is dependent on the future, and the future is uncertain. So you don't want to get a company that depends on future growth all the time, because while it might look good, it might be popular, it might not be what's going to grow your money in the long term. So price to earnings, debt to equity, and return on equity, debt to equity, and PE ratio. These three numbers you want to know. You can go anywhere and look them up and check them out to make sure that you're investing in good companies. Because investing, you're gonna make some mistakes, but you don't want to make no catastrophic mistakes and have FOMO and end up buying into a company and that you're gonna end up losing money. Remember rule number one: you never want to lose money. So catastrophic mistakes might happen, small mistakes might happen, but you don't want them mistakes to be permanent. You don't want to buy into a company that's going to end up delisting on you. So keep you from chasing. These three rules keep you from chasing and protect your capital and keeps you in a safe place when you're considering investing in the stock market. So to close this out, buy good companies, business, reasonable prices. For most good companies, I'd be paying for companies that are in the mid-teens to low 20s PE ratio, because that's the sweet spot. So look for return on equity, PE ratio, and debt to equity. These three numbers right here will guarantee, well, nothing in the market is a guarantee. I can't guarantee anything, but it will assure you that you're buying into good companies with good fundamentals. And as an investor, you want to invest in companies that are fundamentally sound, companies that you can set your money there and forget all about it, and it's going to work for you. So I'm gonna keep this video under 10 minutes, and I hope you get something out of this. If you do, hit that like, hit that subscribe, and I'll bring this information to you consistently, like I have been for the last several months on this channel. The channel is growing, my subs is growing, viewership is growing, and for everybody that's watching, hitting that like, subscribing, I appreciate that. You know, as an OG, trying to play a young man's game, but money is everybody's game, and learning how to earn, learning how to protect your money, being patient in the market is what's going to get you a wealth in the long term. And that's what we're here for. We're here to put our money to work for us so that we can get off that corporate plantation, and I'm going to help you get off of that thing. So with that being said, I'm out of here, y'all. Peace.